Well, thank you, Mr. Chairman, and let me also add my thanks to Ranking Member Paul for giving me the honor of sitting in this chair, and let me add my thanks along with yours to the committee staff as we close out the Congress for all their hard work. And let me add also my thanks to the witnesses for coming today, taking time out of your day to get here and share your wisdom. It's an honor to serve as ranking member for today's important hearing as we examine how the Small Business Administration can best serve small businesses' capital needs, especially for borrowers and underserved communities. Access to capital is always a top issue facing Kansas small business owners and businesses throughout the country. After hosting several roundtable discussions with minority-owned Kansas businesses, it's clear that our entrepreneurs have solid business ideas and plans to grow, but often lack the resources or connections they need to get business off the ground. I frequently hear concerns about the SBA's lending programs are cumbersome from our community lenders and are filled with bureaucratic red tape for the borrowers, who often give up very early in the process. Due to the high-risk status of any new venture and this lengthy application, many banks have decided to stay on the sidelines. Indeed, entrepreneurs need streamlined access to capital so they can focus more on their business and not paperwork. But some things must be working, as SBA approved a blockbuster number of loans in fiscal years 2021 and 2022. According to SBA's data, in fiscal year 2021, the 7A loan program administered more than 50,000 loans for more than $36 billion, of which 30% of the dollars went to minority-owned small businesses. In total, these 2021 numbers represent an increase of $13 billion from 2019 in approved 7A loans. These numbers are promising for the lending programs, but more can be done, and I'm committed to finding solutions with my colleagues so we can provide more opportunities to entrepreneurs across the nation. This is exactly what will turn our economy around and provide more high-paying jobs for all Americans. However, when changing these programs, we can't forget to maintain strong due diligence standards. While still maintaining simplicity, as these programs are government-backed loans, it's essential that prudent lending standards are in place to ensure taxpayers are not footing the bill on risky loans. The 7A loan program has generally operated at zero subsidy, meaning the program administers fees to offset any loan losses. Recently, the SBA announced two proposed rules that would alter the underwriting and standard practices in the 7A and 504 programs. One rule would also lift a 40-year moratorium on how many non-federally regulated lenders the SBA can oversee. While I hope this allows more access to capital, it's concerning to me that the current administration is changing significant lending policies without input from Congress. It's also concerning that the SBA may not be able to adequately provide oversight and examinations of these new SBA lenders through the SBA's Office of Credit Risk Management under these new rules. Many have seen these rule changes as an opportunity to allow fintech lenders into SBA's traditional lending programs. While it's encouraging to see the SBA is attempting to take steps to diversify its lending pool, it's troubling they are coupling it with loosening of program standards. Fintechs had the opportunity to participate in the Paycheck Protection Program, but recent reports have shown fintechs were responsible for a disproportionate amount of PPP fraud compared to more traditional local lenders like community banks and credit unions. Many of the fintechs in PPP had not been subject to Bank Secrecy Act and Know Your Customer compliance requirements, which led to fraudulent PPP applications being processed. These are major concerns that while automation may streamline certain processes, critical vetting and eligibility checks will be left behind and replaced by high-volume business model with the addition of fintechs and lending programs. SBA loan procedures can often be improved, but it is the key technical assistance to borrowers that differentiates SBA lending, ensures that the borrower is not in a predatory loan that they will have difficulty paying back. In light of findings on fintech fraud and PPP, Congress needs to first examine letting fintechs into new federal lending programs before the SBA implements these very significant changes. Thankfully, we'll have the opportunity to start the conversations today. I'm looking forward to hearing from a witness today who are experts on the fraud and wrongdoing in PPP loans, as well as SBA mission lenders who can speak in detail about how they help underserved communities and the impacts these new policy changes will have on program risk. Again, I believe we can do both. Making the process simpler and streamlined will bring in more lenders, yet we must maintain the integrity of the programs. Thank you. I yield back. Ms. Murphy, your business model is built upon trying to get to yes for your customers. People apply online, they come into your bank. You would like to help them within, of course, the rules, get to yes. What are some of the major reasons people are unsuccessful qualifying for this loan? Is it credit score? Is it they don't have a financial statement? Or they just kind of just drop out because they're overcome with the process?
That's a great question. So we generally don't have people dropping out because they're overwhelmed with the process. We do focus as a government guaranteed lender. We do have dedicated resources for the borrower on our team. Where we find the turndowns is usually, the lack of repayment ability. It comes back to the core of what we have to do in SBA is the borrower has to be able to repay the loan. So when they send in their financials and the projections and they can't repay the loan on their projections or historically, then unfortunately we have to tell them right now, no, we need you to be able to repay this loan. When a borrower can't repay and then there's a default, effectively they now have a debt collector of the U.S. government until that is paid in full. When we look at these two proposed rules, the affiliation rule removing the guardrails around underwriting, around the repayment, the basic premise of well-established of how we underwrite, there's a fear that that is where we would have increased program costs because of increased defaults, which hurts the borrower.
Eventually it would. One of the big advantages of a community bank or a credit union is really knowing your customer and being able to, a reputation is still worth something, and you get this, are they hardworking, some of those things. And as you figure out their ability to repay that loan, there's objective measurements. But if you're a fintech program, do you think that they'll be able to assess the ability to repay the loan in the same fashion you will?
I think it comes back to, again, the well-established rules that are already set that the SBA is proposing to remove. With those guardrails down, we just don't know on how these borrowers are going to perform. We don't know what their repayment ability is going to be. And the reality is, as a federally regulated lender, as a bank, we will still be doing those things. Our regulators expect us to do those things. So all of a sudden, our borrowers don't have an equal playing field depending on what lender they're talking to. The rules would be different because the rules are not set by SBA anymore.
Mr. Schwellenbach, as you look at these rules for fintech, do you feel like that they're being held at the same level as community banks and credit unions are?
I'm not sure exactly how to answer that question, but I will echo my fellow witness that the rules of the program are absolutely critical. If you look at some of the internal correspondence by some of these fintech executives talking about these high rates of fraud that they were internally seeing during the Paycheck Protection Program, a lot of them were very dismissive of these high rates of fraud because they said, look, this is on the SBA, the rules are lax, it's on the government. So if you have lax or non-existent rules, how can you expect companies that are participating to stop this? So
an SBA loan, just by definition, is going to be more risky than a PPP loan for a business that's been open for 5 or 10 years. What would we need to add to beef up the rules that we've seen to try to bring fintech to a level playing surface and to try to make sure we don't have more fraud? What needs to be added?
So I want to start off by saying that there's some really unusual things about the Paycheck Protection Program, and that may be the understatement of the day.
Yeah.
But
that's really not my
obviously
question.
It was a huge program. In many ways, it was more of a grant program, since such a high percentage of loans were just forgiven. At the front end, there was sort of this expectation.
I'm sorry, my question isn't about the PPP rules. I'm saying going forward, what needs to be added to give us some less rate of fraud and less rate of failure.
Oh, in the PPP rules or the 7A? The 7A.
The new 7A rules for fintech.
So I think you want to keep a lot of the rules in the 7A program and not weaken them. You don't want to take them in too much in the direction of what you had with PPP. You want to know if the borrower can repay. You want to make sure that the lender who's processing the loan actually verifies that the company seeking a loan actually exists and is an active business and isn't someone who's just going to buy a Rolls Royce with the money and flee to another country. So these lenders or potential lenders, SBA needs to make sure that they have their ducks in the row, that they have their systems in place to know their customers.
Okay, I yield back. Thank you.
And just one more thing, even pre-pandemic, the SBA's Inspector General has found that the SBA's Office of Credit Risk Management was not conducting enough oversight over participating lenders, and this is all pre-PPP.